RBC Economics just put out a detailed report on housing starts in Canada, and it does not look good for Ontario. Canada's housing construction is booming, but one province specifically is lagging behind. In today's video, I'm going to break down how national housing starts remain strong, while Ontario, and especially the GTA, faces a steep decline. We're going to talk about what's behind it and what does it mean for the market. So let's start with the bright spot, Canada overall. According to RBC, housing starts have hit record highs over the past 4 years, topping 1 million units in total. In the first half of 2025 alone, annualized starts averaged 250,000 units, above the pre-pandemic 10-year average of 200,000 units, according to RBC. But as you can see in the yellow line here, that overall strength masks a sharp contrast. Ontario is seeing a noticeable slowdown. Housing starts in the province declined steeply since mid-2024, particularly in the Greater Toronto area. As we know, the GTA is seeing a huge collapse in its pre-construction condo market, which means that buyers aren't lining up to invest in these projects, and therefore builders aren't going to build them. But outside of the province of Ontario, it's not like those markets really rely on the pre-construction sales industry to keep them going. So if everybody else can build without a pre-construction industry, why can't Ontario? And we're going to get into it. Data from CMHC sources show housing starts in Q1 in 2025 dropped to just 12,000 units, down about 20% from the previous quarter, marking the lowest quarter since 2029 in the fallout of the global financial crisis. So it really seems like here Ontario is behaving like it's in a recession, and not just the construction industry. You've got Toronto's unemployment is almost 10%, and Ontario's population growth is actually shrinking because people are leaving the province. Now, zooming in on Toronto reveals a little bit more of an alarming shift. For the first 5 months of 2025, Toronto housing starts plunged 58%, and the rest of the GTA were down 29% compared to the same period in 2024. One of the big reasons for this is Ontario has a huge supply of resale homes for sale, and so there's not a lot of excess demand to spill over into the pre-construction space or the new build space. And we know that pre-construction activity has hit a 30-year low as of June 2025, and developers are seeing major slowdowns. And RBC did a really good job of illustrating this on a chart where they basically just took pre-construction sales 18 months earlier and mapped it beside housing starts in the city of Toronto. And you can see there's a pretty strong correlation, and both are falling off of a cliff. And so without these pre-construction sales in the city of Toronto, we're not going to see more housing starts anytime soon. Now, in a lot of the other provinces, you're seeing housing starts backfilled by rental. And I covered this in a recent video with Brian Yu from Central One Credit Union, where you're seeing a huge increase in rental housing starts across Canada, except Ontario. And the main reason for this is because of the cost structure of developing housing in Ontario. We have some of the highest development charges in the country. We have some of the highest construction costs in the country. You can see on this chart how Ontario construction cost increase pretty much stayed with the Canadian average until the beginning of the pandemic, and then it started to increase at a much higher rate, to the point where now the cumulative increase is about 15% higher than the rest of the country. And you get places like Vancouver where there are very little development charges on rental product, and we know that the city of Toronto is actually considering, they've moved development charges from when you start your project to occupancy, which has helped a lot in cost structuring on the capital stack. But it's still not enough. You've seen a couple of GTA municipalities like Vaughan, Mississauga, and Hamilton start to reduce development charges. But until the cost structure of housing comes down and developers can actually afford to deliver units at a lower price, we're not really likely to see a lot of projects be able to successfully pivot into purpose-built rental projects away from condo. Everybody's trying to do this right now. They obviously want to keep their projects moving. They want to keep shovels in the ground. They want to keep sites moving. They want to realize the revenue that they have tied up in this land. But if the projects don't work and can't qualify for these CMHC MLI Select financing programs, then they just can't do that. Outside of Ontario, it's a lot easier for these projects to pencil because land costs are lower, construction costs are lower, incomes relative to rents are higher, which is a big underwriting criteria that CMHC uses on their housing affordability points that you get for MLI Select. Ontario's projects take a lot longer and cost a lot more, quite simply. In a market where there was excess demand, where there was pre-construction buyers, they could pass a lot of those extra costs onto those pre-construction buyers. But in a market where there isn't pre-construction buyers and there's still no cost savings, it's virtually impossible to absorb all those costs and still qualify as a rental project. So what does this mean for home buyers and builders? For buyers, these trends can lead to tighter supply in the future and potentially aid in the recovery of Toronto's real estate market. We still have a long way to go to get there. We have years of inventory that's coming on the market. We have 50,000 units closing this year, 25,000 condos closing next year, 20,000 the year after that. And so you've got a huge flood of supply still coming to the market. And until that all gets absorbed, you're probably not even going to be thinking about a recovery in either rents or prices. And for builders, this slump really signals needing to adapt, possibly shifting focus to different product types or different regions. I've had a lot of Toronto developers ask me about developing in the Sunbelt in the US. I've had a lot of Toronto developers ask me about developing missing middle rather than high rise. One of the reasons missing middle works is they're smaller projects. So if you're 6 stories or below, you can typically build out of wood, and that would reduce your total creation costs substantially because your construction costs come down a lot. And if you're trying to sell a condo, this would mean that you might be able to deliver a condo in the $900 square foot range where there's actually activity in the market rather than the $1,200 plus per square foot range where there's basically no bid in the market. We're also seeing a lot of smaller developers move down into that multiplex space. And I've talked a lot about multiplexes on this YouTube channel, and I really think that it's one of the only ways that we're going to see housing get built in the city of Toronto over the next couple of years, simply because multiplexes now have no development charges up to 6 units plus an ADU, so up to 7 units. You're starting to see more creative configurations and more advanced developers get into the space. So as an example, you could take a 50-foot lot and sever it into 2, and now you have 2 lots and each one can get 7 units. So you can get 14 units. It's not a meaningful project for a large scale developer, but if you do a handful of them and you can get some economies of scale by them all being in the same location, we could actually see some growth in that sector from bigger players who are moving down into the multiplex or missing middle space. The bigger picture from RBC is that they say how Canada's housing market remains resilient outside of Ontario. And Ontario's municipalities are still issuing lots of building permits, but we're just not seeing those projects actually get built. So people will go, they'll apply, they'll go through their entitlements, they'll get their building permit, and then when they go to break ground, they realize, okay, we actually can't make this project viable. Our construction lender won't give us the money because CMHC won't give us a COI, or commitment of insurance, for the term loan, the takeout loan, or the long-term mortgage on the property. And most construction lenders won't give you debt if you don't have your CMHC takeout financing lined up. And CMHC won't give the money to them because the projects don't economize. They don't meet CMHC's criteria. All in all, I would say this to me is really a reflection of how much pain we're seeing in Ontario's market and how it actually translates to construction activity. I think we've still got a lot more of this to come, to be honest, but I am seeing a lot of optimism for activity in the multiplex missing middle space. I'm seeing a lot of interest even from institutional or sub-institutional investors. And so I'm optimistic that while I just don't think that missing middle and multiplexes are capable of creating enough supply to compete with how much we were doing from a high-rise perspective, I do think that it will deliver some meaningful supply to keep housing affordability where we need it to be. If you found this breakdown useful, please hit subscribe. And as always, I'm going to leave you with a question to answer in the comments. Do you think that we'll see more and more big developers get into the multiplex space? I'm curious to hear your thoughts. Let me know. I always love a good discussion. I try to respond to and read all of my comments, and I appreciate them, so keep them coming. Thanks a lot for taking the time to watch this video. I really appreciate your time, and I'll see you soon.